Imagine this: a perfect breakout. Beautiful volume spike, clean resistance break, everything your textbook said to look for. I took this trade. So did about 10,000 other traders that day. We all got crushed when it reversed 20 minutes later. Here's what's wild. I had the right setup, the right risk management, even the right mindset according to most trading books. But I was still trading like an amateur because I was missing the deeper game that Mark Douglas spent decades uncovering. Most traders think Douglas is just about thinking in probabilities and managing emotions. That's kindergarten level. The real edge, the stuff that separates traders making $10,000 a month from those making $10,000 a year, is buried in 3 invisible systems that Douglas mapped, but most people never implement. First, how your belief system literally filters what market data you can even see. Second, why embracing randomness as your friend, not your enemy, is the ultimate competitive advantage. And third, how to pre-accept risk so completely that fear becomes irrelevant. I've been trading for 7 years, made every mistake in the book twice, lost more money than I care to admit. But in the last 3 years, something clicked. Not because I found a better strategy, because I finally understood what Douglas was really teaching. Today, I'm going to show you the hidden Douglas framework. Not the quotes everyone posts on Twitter, but the actual system that transforms how your brain processes uncertainty. By the end of this, you'll have 5 specific drills you can start using tomorrow that will fundamentally change your relationship with risk. This is the Sci-Fi Trading Channel. Here we focus on mastering our minds so we can master the markets. This is going to be a good one. Sit back, relax, and let's get into it. Quick question for everyone listening, and be honest with yourself. How many of you have had a trading system that worked in backtesting but struggled when you went live? I'm betting most of you are nodding yes right now, which is exactly what I expected. Here's why that happens, and it's not what you think. The conventional wisdom says it's about emotions. You get scared, you get greedy, you deviate from the plan. True, but that's still surface level. The real issue is that you have 3 invisible enemies Douglas identified that most traders never even know they're fighting. Enemy number 1, belief filters. Your brain doesn't show you objective market data. It shows you market data filtered through your personal belief system about what good trades look like. Enemy number 2, randomness resistance. You're wired to find patterns and meaning in everything, but markets distribute outcomes randomly, even with an edge. This creates a constant internal conflict. Enemy number 3, identity attachment. Your self-worth gets tangled up with your P and L. When that happens, every trade becomes a judgment on your intelligence, your worth, your future. Here's the thing, these aren't character flaws. They're not weaknesses. They're how human brains work. But they're incompatible with profitable trading unless you have a specific system to work with them. Let me tell you about Sarah. Sarah's a software engineer, makes great money, super analytical. She developed this momentum system, really solid 58% win rate, great risk reward, backtested beautifully over 2 years of data, goes live, and after 3 months, she's basically flat. Same system, same rules, but she's somehow avoiding half the signals. We dig into her trade log, and I notice a pattern. She's skipping every setup that happens in the first hour of the market. Why? I ask her. Those early moves are just noise, she says. Real momentum happens after institutions position. Picture a perfect early morning breakout that worked beautifully, the kind she was systematically avoiding. Sounds logical, right? Except her system never filtered for time of day. She was unconsciously adding a belief filter that wasn't in her rules. That belief, early moves are fake, was literally preventing her from seeing valid signals. But here's the crazy part. She wasn't lying or being lazy. Her brain was protecting her from what it perceived as risky trades by making them invisible. Her belief system was editing reality in real time. This is what Douglas meant when he said the market is always communicating, but we're not always listening. We're not listening because our beliefs act like noise-canceling headphones, filtering out information that doesn't match our internal model of how things should work. The attention exercise. Before we go further, I want you to do something. Right now, wherever you are, I want you to focus on all the sounds you can hear. Take 10 seconds and really listen. Every sound, from the obvious to the subtle. Now focus only on sounds that are coming from your left side. Notice how different sounds become prominent when you shift your attention. Here's the thing. All those sounds were there the whole time, but when I directed your attention to the left, your brain filtered out sounds from other directions. This is called selective attention, and it happens in trading constantly. Your beliefs about what makes a good trade work exactly like this. If you believe breakouts only work with high volume, your brain stops seeing valid low volume breakouts. If you believe trend trades are safer than counter trend trades, you'll miss profitable counter trend setups. Sarah's breakthrough came when she realized her early move filter wasn't wisdom. It was just a belief. And beliefs can be changed. Douglas drill number 1, the belief audit. Here's your first drill, and this one's critical. Every morning before you trade, write at the top of a piece of paper, what must be true for me to feel confident taking this trade? Set a timer for 2 minutes and brain dump every answer that comes up. Volume needs to be above average. The move should look clean. I need some confirmation. It shouldn't be too early in the session. The broader market should be trending. Don't edit yourself. Just dump it all out. Now here's the key. Circle anything that's not explicitly written in your trading plan. Those circled items? Those are belief filters, not trading rules, and they're probably costing you money. Sarah did this exercise and discovered she had 12 unwritten rules that weren't in her system. 12 invisible filters screening out valid trades. 1 month after removing them, she was up 23% instead of flat. The two-brain problem. Here's what Douglas understood that most people miss. You don't have one brain making trading decisions. You have two. System 1, fast, emotional, pattern seeking, wants to protect you from danger. System 2, slow, logical, analytical, actually understands probabilities. System 1 developed over millions of years to keep you alive. If you saw a rustling bush, you didn't stop to analyze whether it was wind or a predator. You ran. This system is incredibly good at keeping you alive, but it's terrible at trading because it treats every uncertain outcome as a threat. Your belief filters are System 1's way of making you feel safe. I'll only take the obvious breakouts. I'll wait for confirmation. These feel like wisdom, but they're often just fear dressed up as prudence. The goal isn't to eliminate System 1. You can't. The goal is to give System 2 a clear framework that System 1 can trust. I want you to imagine I'm flipping a coin 20 times. Heads is a winning trade, tails is a losing trade. This represents a trading system with a 50% win rate, which, by the way, can be incredibly profitable with the right risk-reward. Here's how it played out. Flip 1, heads, flip 2, tails, flip 3, tails, flip 4, tails, flip 5, tails. Look at that. 4 losses in a row, right at the start. If this were your trading, how would you feel right now? Be honest, most of you would be questioning your system, wondering if something's wrong, maybe thinking about skipping the next few trades or changing your approach. But it's just math. With a 50% system, you'll get 4 losers in a row about 6% of the time. It's not personal. It's not a message. It's just variance. I ended up with 11 wins and 9 losses, better than 50%, but only because of randomness. Next week, I might get 8 wins and 12 losses. The point is, no individual flip or trade means anything. The edge only emerges over many trials. The casino mindset, think about casinos. They don't care if you win the next hand of blackjack. They might even hope you do. Keeps you playing. Why? Because they know their edge plays out over thousands of hands, not individual ones. You need the same mindset. Your next trade is irrelevant. What matters is whether you have an edge and whether you're executing it consistently across a large sample size. Let me tell you about Marcus. Marcus developed this great breakout system. 62% win rate, 1.5 R average winner, 1 R average loser. Solid edge, but he kept getting crushed by losing streaks. The problem wasn't his system. The problem was he was judging his system after every 5 or 10 trades. 3 losses in a row, and he'd start tweaking parameters or skipping setups. He was trying to control variance instead of accepting it. We made one change. Marcus could only evaluate his system after completing blocks of 50 trades. Not 49, not 51, exactly 50. During those 50 trades, his job was binary. Execute valid setups with correct position sizing, nothing else. The streak reframe. Most traders see losing streaks as evidence something's wrong, But what if I told you losing streaks are actually evidence your system is working correctly? Here's why. If you have a 60% win rate, you should expect to see losing streaks of 4 to 5 trades fairly regularly. If you never have losing streaks, it means you're probably not taking enough trades or you're cherry picking only the most obvious setups, which usually means you're missing your edge. Winning streaks feel good, but they're just as meaningless as losing streaks. The magic isn't in avoiding the streaks, it's in staying consistent through both. Douglas drill number 2, the 20 trade contract. Here's your second drill, and this one will change everything. Before each trading session, read this out loud. My edge expresses itself over a series of trades, not individual outcomes. I will judge my performance only after completing the next 20 qualified setups. Until those 20 trades are complete, my job is simple. Identify valid setups, size correctly, and honor my predefined risk. Everything else is noise. Print this out, laminate it, read it every morning, because the moment you start judging your system based on the last 3 trades, you've stopped being a trader and started being a gambler. The independence principle. This is crucial. Every trade you take is independent of the last one. The market doesn't know you just had 4 winners in a row. It doesn't know you need a winner to pay rent. It doesn't care about your emotions or your financial situation. This independence is actually your friend, not your enemy. It means a losing trade doesn't increase the probability of the next trade losing. A winning trade doesn't mean you're due for a loser. Your system's edge resets fresh every single time. But your brain hates this. It wants patterns, causality, predictability, so it creates phantom patterns. I always lose on Fridays. Morning trades work better for me. I'm in a hot streak, time to size up. Most of these patterns are just your brain trying to make sense of randomness. The solution isn't to fight your brain, it's to give it a different job. Instead of looking for patterns and outcomes, focus on patterns in your process. Are you following your rules? Are you sizing consistently? Are you honoring stops? These are the patterns that actually matter. 3 years ago, I took a trade that changed how I think about risk forever. It was a perfect setup. Everything aligned. I sized it at 2% risk, which was normal for me at the time. The setup triggered, and immediately, the stock started moving against me. Now I had my stop set at exactly where it should be according to my plan, but as the price approached that level, something weird happened. I started bargaining with myself. Maybe I should give it a little more room. This setup is too good to stop out. I'll just move the stop 50 cents lower. I ended up taking a 4.2% loss instead of 2%. But here's what really bothered me. I thought I had accepted the risk when I placed the trade. I thought I was prepared to lose that 2%, but clearly I wasn't. That's when I realized the difference between mechanical risk acceptance and psychological risk acceptance. Most of us think we've accepted risk when we set a stop loss, but setting a stop is just mechanics. True risk acceptance happens in your mind before you even click the buy button. The 2 types of risk acceptance. Mechanical risk acceptance. I'll risk $1,000 on this trade. Psychological risk acceptance. I am completely okay with losing $1,000 on this trade. Massive difference. The first is about what you'll do. The second is about who you are when facing uncertainty. Until you achieve psychological risk acceptance, your brain treats every adverse price movement as a threat. And when your brain perceives threat, it hijacks your executive function. You start making emotional decisions instead of logical ones. The pre-loss visualization. Let me share the technique that changed my relationship with risk forever. Before every trade, I spend 30 seconds mentally rehearsing the loss. I close my eyes and visualize the trade going against me. I see the price hitting my stop. I imagine getting the execution notice. I feel the temporary disappointment. Then I imagine moving on to analyze the next setup. This isn't negative thinking, it's preparation. Athletes do this all the time. They visualize missing the shot, striking out, falling during the routine, not to manifest failure, but to remove the fear of failure. When you've already mentally experienced the loss, the actual loss becomes much easier to handle. Your brain recognizes the situation. Oh, this is that thing we practiced. I know what to do here. Douglas drill number 3, the risk acceptance ritual. Before every single trade, read this contract out loud. And I mean actually out loud, not just in your head. I choose to take this risk. If this trade results in a loss, nothing is fundamentally wrong. My trading system is not broken. My future is not in jeopardy. This loss is simply the price I pay to express my edge in an uncertain environment. I accept this outcome completely. If you can't read that statement without tension in your chest, your position size is too large. Reduce it until you can read the contract calmly. This isn't just feel-good psychology. This is practical risk management. Because the moment you're not okay with losing, you're going to do something stupid to avoid the loss. The identity stop loss. Most traders set a stop loss on their charts, but no stop loss on their identity. What do I mean by that? Your chart stop loss says, if price hits this level, I exit the position. Your identity stop loss says, if this trade doesn't work out, I'm still the same person with the same skills and the same future. Sarah, the engineer I mentioned earlier, had perfect chart stops, but no identity stops. Every loss felt like evidence she wasn't cut out for trading, so she'd hold losers longer than planned, hoping they'd come back and prove she was smart. Once she installed identity stops, accepting that losses were just business expenses, not intelligence tests, her trading transformed overnight. The two traders' story. Let me show you the difference between someone with and without psychological risk acceptance taking the exact same trade. Trader A enters a breakout trade with a 1% stop loss. Price immediately moves against him by 0.3%. His internal monologue, damn, this better turn around. I really need this one to work. Maybe I should give it more room. This setup was too good to fail. He's tense, checking the chart every 30 seconds, second-guessing his stop placement. When price hits his stop, he's devastated. He spends the rest of the session either avoiding trades or revenge trading. Trader B enters the exact same trade. Same 1% stop. Price moves against her by 0.3%. Her internal monologue, interesting. Let's see what the market decides. I've already accepted this 1% cost for the privilege of having an edge. She's calm, maybe checks the chart once or twice, then goes back to scanning for the next setup. When price hits her stop, she notes the result and immediately starts analyzing the next opportunity. Same setup, same outcome. Completely different trading experience. The difference? Trader B pre-accepted the risk at a cellular level. I want you to imagine two equity curves from the same trader, 6 months apart. The first one is a psychological mess. Big ups, bigger downs, lots of volatility. The second one is smooth, consistent growth. Same person, same market, same basic strategy. What changed? He stopped measuring success by dollars and started measuring it by process integrity. This might be the most important shift you can make as a trader. The two success definitions. Outcome success. I made money today. Process success. I executed my edge with discipline today. Most traders are addicted to outcome success. They feel good when they make money and bad when they lose money, regardless of how well they followed their process. But here's the paradox. The more you focus on making money, the less money you make. Why? Because when your mood depends on individual outcomes, you start making decisions based on recent results instead of your edge. Let me tell you about David. David's a surgeon, literally saves lives for a living. But in trading, he was a wreck. He'd have a great week, get overconfident, size up, then lose it all the following week. The breakthrough came when David realized he was applying two different success criteria to his two professions. In surgery, success equals, did I follow proper procedure? In trading, success equals, did I make money? In surgery, a patient dying doesn't make David question his skills if he followed protocol perfectly. He understands that sometimes good process leads to bad outcomes. That's just medicine. But in trading, he was taking every loss personally, as if it meant he'd done something wrong. Once he started applying surgical thinking to trading, measuring success by process adherence, not patient outcome, his results transformed. Clean process executions. This is the metric that changed my trading forever. Clean process executions, or CPEs. A CPE is any trade where you only took a qualified setup according to your rules, sized the position according to your plan, pre-accepted the risk mentally before entering, managed the exit according to your system, no meddling, journaled both the technical setup and your emotional state. Notice what's not on that list, whether you made or lost money. A CPE can be a winner or loser. What makes it clean is process integrity, not outcome. When I started tracking CPEs instead of just P and L, something amazing happened. My win rate stayed roughly the same, but my average winner got bigger and my average loser got smaller. Why? Because I was no longer fighting the process. I was honoring it. Douglas drill number 4, the CPE scorecard. After every trading session, score yourself on these 5 questions with a simple 0 or 1. Did I only take setups that met my written criteria? No, almost setups. Did I size each position according to my predefined risk parameters? Did I read my risk acceptance contract before each entry? Did I let my stop loss or profit target manage my exits without interference? Did I record both what I saw in the market and what I felt as a trader? Score 4 to 5 out of 5? That's a successful session, regardless of P&L. Score 0 to 3? That's a learning opportunity, regardless of P&L. Your goal is to stack 20 consecutive sessions with CPE scores of 4 or 5. Once you hit that milestone, then you can look at your P and L, not before. The identity shift. The hardest part of this transition was realizing that my identity was completely wrapped up in my trading results. When I made money, I felt smart, successful, worthy. When I lost money, I felt stupid, like a failure, like I should quit. This emotional roller coaster wasn't just unpleasant, it was actively sabotaging my performance. Because when your self-worth depends on your last trade, you make desperate decisions. You hold losers too long to avoid admitting you're wrong. You take profits too early to lock in the feeling of being right. You skip good setups after losses because you can't handle another hit to your ego. The shift happened when I started deriving pride from something else, my ability to execute under uncertainty. Instead of I'm smart because I made money, it became I'm professional because I honored my process despite not knowing the outcome. This isn't just psychological feel-good stuff. This shift has a direct impact on your bottom line because it frees you to take every valid setup without fear and to exit every trade according to plan without hope. Douglas outlined 3 stages every trader goes through if they stick with it long enough. Most people get stuck in stage 1 or rush to stage 3 without mastering stage 2. Let me break down what each stage actually looks like and how to progress through them properly. Stage 1, mechanical trading. In stage 1, you follow your system like a recipe. No discretion, no gut feelings, no clever adjustments. If A and B are present, you do C, period. This stage feels boring. It feels unsatisfying. Your brain will rebel against it because it wants to be creative, to outsmart the market, to prove how smart you are. Ignore your brain. Mechanical execution is not the destination. It's the foundation everything else is built on. Your goal in stage 1, complete 100 trades with 90% plus rule adherence. Not 80%, not pretty good, 90%. This creates what Douglas called self-trust. Until you trust yourself to follow simple rules consistently, your brain won't let you access the deeper pattern recognition that comes later. Most traders skip this stage or rush through it. They want to be flexible, intuitive, discretionary from day one. This is like trying to improvise jazz before you can play scales. The improvisation might sound creative, but it's usually just noise. Stage 2. Subjective trading. Stage 2 is where you earn the right to use bounded discretion. You might pass on an otherwise valid setup because major earnings announcement in 30 minutes. The broader market is in a clear downtrend. Volume is unusually low across the sector. The setup is valid, but the reward to risk is below your standards. The key word is bounded. Every discretionary decision must be predefined in your playbook. You're not making stuff up on the fly. You're applying a more nuanced version of your rules. Sarah, my engineer friend, progressed to stage 2 after 5 months of mechanical trading. She added 3 discretionary filters: skip breakouts within 30 minutes of major economic releases, reduce position size by 50% when the VIX is above 30, pass on setups where the daily ATR suggests less than 2R potential. These weren't emotional decisions. They were logical extensions of her mechanical system, based on her observations during stage 1. Stage 3, intuitive trading. Stage 3 is the holy grail that everyone wants, but few achieve. Here's the secret. Intuition isn't magical. It's not some mystical connection to the market. It's pattern recognition without fear. After thousands of repetitions in stages 1 and 2, your brain starts recognizing subtle patterns that can't be easily coded into rules. The way price action feels around key levels, how volume tends to behave before major moves, the difference between a breakout that wants to go and one that feels forced. But here's the critical point. Intuition only works when fear is absent. If you're still afraid of being wrong, if individual losses still sting your ego, if you haven't truly accepted risk, then what you think is intuition is actually just anxiety dressed up as insight. True intuition whispers, fear shouts. Most traders mistake the shouting for insight, the quiet day story. Let me give you a real example of stage 3 intuition. Last month, I had 2 identical breakout setups on the same morning. Same pattern, same volume, same technical criteria. According to my rules, both were valid trades. I took the first one without hesitation, made 2.8R. The second one, I looked at for about 30 seconds and passed. No logical reason, it just felt off. That breakout failed spectacularly 20 minutes later. What was the difference? Something I can't easily put into words. The way other stocks in the sector were acting, the quality of the bounces off support levels, the rhythm of the tape. None of these were in my written rules, but after years of observation, they'd become part of my pattern library. This is stage 3. Not gambling, not hoping, not guessing, just pattern recognition refined by thousands of hours of disciplined observation. Douglas drill number 5, the one not taken journal. Here's how you develop real intuition. Every week, identify one valid setup you chose not to take and write down why. Not the logical reasons, the felt sense. Something felt off about the momentum. The breakout looked forced. The broader context didn't feel supportive. Over time, you'll start seeing patterns in your felt sense decisions. Some will be legitimate intuition, subtle pattern recognition your conscious mind hasn't categorized yet. Some will be fear disguised as wisdom. Your job is to track both. The legitimate intuition becomes stage 2 rules. The fear-based decisions become areas for more psychological work. All right, we've covered a lot of ground. Theory is nice, but transformation happens through practice. Here's your 30-day implementation plan. 5 drills that will rewire how your brain processes uncertainty. Week 1 to 2, foundation building. Complete the belief audit every morning. 5 minutes, read the risk acceptance contract before every trade, score your CPEs after every session. Identify and eliminate at least 3 belief filters. Week 3 to 4, sample size thinking. Commit to 2 complete 20-trade evaluation blocks. Track only rule adherence and process quality. Ignore profit and loss. Complete the one not taken journal. Experience true randomness acceptance. The 30-day challenge metrics. Success isn't measured by how much money you make in these 30 days. Success is measured by belief. Clarity, can you identify when you're adding unwritten rules? Risk acceptance. Can you read the contract without physical tension? Process pride. Do you feel good after high CPE sessions regardless of profit and loss? Sample thinking. Can you stay disciplined through losing streaks? Intuition development. Are you noticing subtle patterns you can't yet articulate? What to expect? Let me be realistic about the journey ahead. Week 1, you'll probably hate the drills. They'll feel mechanical and boring. Your brain will resist. This is normal. Week 2, you'll start noticing belief filters everywhere. You might feel overwhelmed by how much unconscious stuff was driving your decisions. This is progress. Week 3, the drills will start feeling more natural. You might have your first experience of true risk acceptance, taking a loss without emotional turbulence. This is breakthrough. Week 4, you'll likely see your first real edge expression. Not because you found a better system, but because you stopped fighting the randomness in your current system. Beyond 30 days. This isn't a 30-day fix, it's a 30-day foundation. The traders who make serious money aren't smarter than you. They don't have secret indicators or better market access. They just have a more mature relationship with uncertainty. That maturity doesn't happen overnight, but it does happen predictably if you commit to the process. I want to leave you with a challenge. Not about making money, about making a decision. You can keep trading how you've been trading. Keep hoping the next system, the next indicator, the next market will be the one that changes everything. Keep riding the emotional roller coaster of wins and losses. Or you can accept that trading is primarily a psychological game played out through technical analysis. You can commit to the unglamorous work of building self-trust, accepting uncertainty, and measuring success by process instead of outcomes. The market doesn't care which path you choose, but your future self does. If this resonated with you, hit subscribe. Sci-fi is for traders who want to master the mental game, not just memorize chart patterns. In the comments, tell me which drill you're starting with tomorrow, and which belief filter you're retiring starting today. Remember, the market won't reward your need to be right. It will reward your willingness to be wrong, and to be okay with that. See you in the next one.